I don't hear any of them talking about it. They all think the Fed's going to make the problem go away. But a 10-year Treasury at 5% yield, alarm bells will be going off because that is really ugly.
What would the banks do once Treasuries hit the yield hits 5%?
They're going to come to Washington and look for salvation. Because let me put a number on that for you. A 10-year at 5% yield, you're talking about a negative capital position for the U.S. industry of about $3 trillion.
What is the Fed's next move now that hedge fund manager Scott Bessent has been appointed Treasury Secretary? What's next for the markets? How will Bitcoin, stocks, Treasury yields, gold respond in the medium term? And the financial sector, are banks still at risk? Well, our next guest, Christopher Whalen, chairman of Whalen Global Advisors, has been warning about the dangers that the banks have faced for quite some time. He was on the show in July. Check out that interview, link down below. We'll be updating his views on the banking sector. Will banks fail in 2025? We'll find out. Christopher, welcome back to the show.
Thank you, David. Appreciate it.
So let's talk about the Fed first before we talk about the markets. It's expected that the Fed will cut by another 25 basis points in December. They've already cut by 50 basis points in September and 25 at the last meeting. So a December rate cut by 25 basis points would equate to 100 basis points of cutting this year. What's your expectation, first and foremost, before we evaluate whether or not they're on the right track, broadly speaking?
Well, it's interesting. I think everyone's expectations was, do we go in December? But I'm not sure Powell has consensus on the committee. He doesn't like to have dissents. Even Mickey Bowman's very mild dissent in September, I think, caused him some heartache. So, there's contrary data. Depending on what you want to look at, you can either say cut or don't cut. And you've seen that reflected in some of the commentary from members of the committee. So if they cut in December, would I be surprised? No, but I wouldn't be surprised if they wait, because I think Powell enjoys making Trump wait. So there's a political dimension to this too.
Okay. Why would they wait, though? Political dimension aside, is there any economic data that suggests that the economy is heating up and perhaps the unemployment situation is getting better or inflation is under control?
Well, no, you have neither. You don't have a big credit problem. You don't see recession on the horizon. You see stress in the bottom quartile of consumers, certainly. If you look at the numbers from the FHA for low-income households, they're pretty bad. We're up in the low teens in terms of default rates. The rest of the complex of consumers is fine. So if you're the Fed, you're not feeling great urgency to cut. It's not like 2020 when everybody fell off the edge of the table. But I think that there is a lot of confusion in the data. The big thing they worry about, by the way, David, is liquidity. They still don't have a way of accurately measuring liquidity. And I think, we've been writing about this in the blog. It's just a fact of life. They don't, they try and measure the liquidity needed in the system based on GDP. They use a model that Bill Poole from St. Louis designed years ago for very short-term liquidity needs, and they use it over a period of months and years. So, they're flying blind. And I think that's the big worry for the Fed, is making sure that we don't repeat December of 2018, because that was bad.
They were telegraphing, I think, a cut by as early as July. By the time September rolled around, they finally cut by 50 basis points. Some people speculated that was to catch up on the cut that they should have done in July. So 25 in July, 25 in September.
I think the street, the street was trying to stampede them into a cut. The street gets very antsy when they're not making money. And the last couple of years were tough. IPO volumes, other than debt refinancing, there wasn't much else going on. Investment banking was very, very flat. So, the street was singing its own song, and the Fed allowed themselves, I think, to be pushed because Joe Biden was in the White House. With Trump, it's a different thing. We'll see what happens. We have this new fellow, Bessent, nominated as Secretary of the Treasury. Seems very level-headed, reasonable choice. I think conservatives will forget the Soros connection pretty quickly. And, we needed somebody else of a Steve Mnuchin kind of quality and intellectual capacity to lead Treasury. It's the most important position in the government. So I think Bessent fills all those needs.
Stock markets rallied Monday on the news that Bessent was appointed Treasury Secretary. He's advised Trump to create what's called a 3-3-3 policy, which includes cutting the budget deficit to 3% of GDP by 2028, pushing GDP growth to 3% through deregulation and pumping out 3 million barrels of oil each day. What are your reactions to this?
I think that's a good old-fashioned Republican agenda, and I'm glad to see them leading with the deficit. You know, this system is tuned up to finance $1.5 trillion worth of new paper from the Treasury. If you cut the deficit, if you show the right movement in terms of getting the government under control, and just, I think, in general, having better governance for the United States, and we saw under Joe Biden, the rates are going to go down, David. The capacity in the market, the demand for risk-free collateral, not just currency, mind you, but risk-free collateral for financial transactions is still vast. So if Treasury got the deficit down to $1 trillion, rates will fall. That's how Donald Trump gets interest rates to fall. He doesn't have to jawbone the Fed. Just work on the deficit a little bit. Turn Elon Musk loose in the defense sector, right? You know how much waste there is in defense. My God, there's got to be a couple $1 trillion there, you know, with all these offshore operations and wars and yada, yada. The U.S. has been spreading money around, you know, going back to the original 9/11 attacks, trillions and trillions of dollars. It's been like a new Marshall Plan. And I think if you get that under control, you get the deficit under control very quickly.
So
this economy grows. If you do 3% growth, you'll have higher growth in revenue.
Deficit aside, can the economy withstand interest rates on the debt level? I didn't see anything about reducing the level of debt in this 3-3-3 policy.
Well, no, your first objective is to slow the rate of growth. That's what you have to do first. You have to get the rate of growth down so it's negligible. And then you have to start really figuring out how you either raise revenue or cut spending and start to run a slight surplus. But that's a long way away. That's the next president. If they can just get the horses under control, that's really step one. And I think, you know, it's doable. Americans have been having a party for years. We didn't want to deal with this. I can't remember the last time the Senate actually passed a budget resolution. You know what I mean? So it's incumbent on everyone to focus on this. So it's hard. Americans don't want to do this. It's the last thing they want to do.
Well, what do they want to do? Spend more money?
Yeah, they want to spend more money. They want to work harder and make money. Pumping oil, obviously, is very attractive. I think that's a very interesting gambit by Trump, because what that says to Vladimir Putin and the Saudis and everybody else is that we're going to bury you in oil. If we drive energy prices down, you can break all of those constituencies and get them to behave. Yeah. The Iranians, same thing. All of these are commodity exporters, and if you force the cost of energy down, you help American consumers. And obviously the economy. But, you know, it's funny. Energy prices have been the real positive in terms of American inflation going back 30, 40 years. It was really 20 plus years in the early 80s to the 2000s where energy prices were falling. So that was always a benefit to the economy. We haven't had that so much in the last 4 years because the Democrats deliberately pushed up energy prices. I mean, here in New York, the Democrats thought it was helpful to push up energy prices. That's one of the reasons they did so badly.
So oil, on that note, oil is down about 3% today. What is the Bessent trade for you? Is it short oil, short gold? Gold's down. Bitcoin is down today. Stocks are up. Yields are down. So long bonds, long stocks, short energy, short gold. Is that the trade?
No, you know, I don't know about the short gold piece. I think stocks have been doing extremely well. My financials have been rocking. For no particular reason. The earnings aren't great. They did okay in the third quarter because rates fell. People were getting excited. They thought they'd be making a lot more loans. I mean, imagine, David, if you were running a mortgage company at the end of September, you thought, yeehaw, my volumes are going to double next year. That's not the case now. We're back up to 7% mortgages. So the markets have been quite volatile over the past several months. And I think you're right. We may see a sell-off now. But we could also see the 10-year retrace a good bit. I think there's going to be a lot of volatility, but, you know, honestly, I think the 10-year could be closer to 5 than 4 by the end of this year. I think short rates have to go down at some point. The Fed will find a reason to cut short rates, right? So you get Fed funds down, that helps the street, that helps a lot of things, asset-backed securities, all of that runs off the short end of the curve, right? But mortgages, a lot of other parts, corporate debt, they all price off the long end. And I think the long end's going to be higher. We're going to have a normal yield curve, which is not necessarily a bad thing. It's just a shock after 20 years of government intervention in the money markets and the bond market.
So the long end is going to go up, 2 years going to go down. Steepening of the yield curve, does that signal to you recovery of the economy or not recovery? Is it growth in the economy, strength?
If we could have normalcy and a little less activity from the Fed, especially no open market operations, I don't want to see them restart QE and start buying paper again. Treasury, obviously, as you pointed out earlier, right, they have to fund short. That's their only choice. However, Janet Yellen made a big mistake. She should have been terming out debt in 20 and 21 when she could. Forget Peter Fisher, okay? The guy who decided we didn't need long bonds. So, I think we need more astute management by Treasury. I would like to see Treasury go to Congress and restart gold purchases. Okay, I share this with Judy Shelton. I think Treasury ought to be buying gold, and I think Treasury should be selling credit default swaps.
Why
we traded twice the spread of Berkshire Hathaway right now. The U.S. is around 40, Berkshire's around 20. I think we should sell credit default swaps till we're back down to 20.
Why are markets pricing a higher risk of U.S. Debt versus Berkshire Hathaway?
Because of liquidity, I think number one, they look at the issuer, and the issuer has no problem paying its bills. It's like Apple, right? It's like any of the large cap tech companies. There was a time before World War I that governments had inferior credit to private companies. We may be going back there. But I think the real point here is that we have to defend the fiat system. The dollar is the monopoly currency in the United States. We can't have crypto. We should ban crypto. It makes no sense for the United States to tolerate cryptocurrencies if we're going to run our own fiat game, right? We were first. I'm sorry.
Okay, so you don't like the Bitcoin reserve idea, I take it.
No, it's ridiculous. Listen, the US dollar was the original cryptocurrency. We didn't have the internet during the Civil War, but if we did, we would have used it, trust me. It was created in desperate times, and really since the Great Depression and Roosevelt's devaluation and seizure of gold, we've been on a fiat system, so we can't tolerate competition. We have to get rid of the competitors. The Chinese understood this immediately. That's why they banned crypto in China.
By the way, the Treasury general account is little over 737 billion. Yeah. And Berkshire Hathaway's cash reserve is 325 billion. So
I don't know. Warren knows something. He's been selling stocks.
Yeah.
He's been getting out of banks. He's been getting out of the big banks.
U.S. government and Berkshire Hathaway. Speaking of banks, take a look at this article here. U.S. banks, this is the headline from Bloomberg from last week. Paper losses ease at U.S. banks. U.S. banks made progress in making sure that the paper losses they piled up during last year's industry turmoil never become real ones. Virtually all of the lenders in KBW's two main bank indexes reported that unrealized losses in their portfolios shrank in the third quarter. It's the first time that this has happened since the 2023 crunch that led to 3 of the 4 largest bank failures in the U.S. What do you make of this?
No. But you see, that was in September. This is a great story because it illustrates what I was talking about before. September, rates were falling. We were going through 3 on the 10-year. Now, all of a sudden, we're back in the 4s. And mortgage rates, the spreads have widened. So I think, there's been quite a shocking turnabout since the Fed rate cut. Then we had some kind of bullish economic data that made everybody say, uh-oh, we can't cut more. And we've since had a bunch of disparate data all over the place, depending on what you want to look at. But, the reality, David, is that the Fed didn't really tighten very much in the last cycle. They didn't even reduce reserves at all because they were so concerned about maintaining the market for the Treasury and everything else. When you see the Treasury market evaporate in March of 2020 and you're sitting at the Treasury, that kind of affects your policy perspective. This is why they forced everybody to do centralized clearing of treasuries. They've been desperately trying to defend this market. So, I think people want to believe that things are much stronger than they actually are. If you look at the 20-year auction last year, or last week, it was not particularly good. It's a bad tenor, though. Nobody wants 20-year bonds.
Okay, what does the market want right now?
They want short. There is a little constituency for 10s and 30s, but not much. It would be hard for Treasury to issue a lot of 10s or 30s right now. They're almost forced to issue T-bills, anything inside of 1 year. They can go out to twos. But, the Yellen Treasury was hiding from the deficit by doing nothing but T-bills, which I think was irresponsible. In 2020, Janet should have been issuing a lot of long bonds. The market was paying you to do it, and they missed the opportunity.
Do you think there could ever be a scenario where we get a failed Treasury auction?
Yes, we've had two. In 2008, the primary dealers were annihilated. The survivors were bought by banks, right? We lost 5 substantial dealers, including Bear, where I used to work. And then in 20, there was no one there but the funds. And at the end of March, when COVID hit and nobody knew what the hell was going on, and people were giving away collateral like mortgage servicing rights, they were giving them away. They didn't know what they were worth. That scared the Treasury because the auctions had to be bought by the Fed. The Fed bought auctions for 2 weeks, and then they continued to buy Treasury paper and mortgages. They bought trillions of dollars in mortgages, which is why they're losing so much money now.
Yeah, by the way, you came on the show in July. You were talking about how if Freddie and Fannie go out of conservatorship,
Yes.
that would help, or not help, that would create some stress to the system. Can you elaborate on that?
Well, Fannie and Freddie come out, the spreads are going to widen. In other words, the cost of the mortgage to you, the consumer, is going to widen probably half a point from where it is today. So when you're comparing a Ginnie Mae mortgage to Fannie Freddie, the Fannie Freddie is going to be a good point higher. That's sticker shock for Americans. Now, what will happen over time is that Fannie and Freddie would have to raise their fees for guaranteeing mortgages. It's about 50 basis points today. They would probably have to raise them up to 70 or 80 to make money. They'll have to pay the Treasury to guarantee their bonds, but they themselves will be private. And they will probably end up as single A plus, maybe double A credits. Moody's will immediately rate them as finance companies when they come out. So effectively, they'll be like, Penny Mac and Mr. Cooper. And they're going to have to make some tough decisions about their business. But they can't stay in the insurance business. That's the key point I keep making to people. They have got to have Treasury cover the bonds, because can you imagine if Fannie and Freddie came out and Moody's downgraded $8 trillion worth of residential and multifamily bonds? That would not go well. So, the problem with Fannie and Freddie is they really function best with sovereign support. The private capital doesn't matter at all. And I'm speaking as somebody who worked in the ratings business. I signed thousands of rating letters when I was at KBRA. And, Fannie and Freddie, if you want to keep them the way they are, as both an issuer of securities and a guarantor of mortgages, right, then you have to have sovereign support. That's the only way they work. And I think ultimately they probably won't come out. Kevin Warsh had some very interesting comments about this a couple of weeks ago. And, I think he understands. I'm sure Scott Bessent understands the importance of sovereign support, because Moody's has said, as soon as you make changes to the relationship, they're going to get downgraded. And they said 2 notches. So that means for a Moody's rating, AAA, you're going to go down to a AA. And I think that'd be a shock for a lot of people.
Well, I wonder what Scott Bessent's going to do about this chart. This is from the FDIC quarterly, second quarter, unrealized losses also of held to maturity securities, as well as available for sale securities, underwater by a significant portion, much larger than 2007. Now, I understand that most of these will be held to maturity, so not an immediate...
No, that's not true. They're sitting on them. And remember, the third quarter was better. Your surrogate is the 10-year Treasury.
Okay.
If the 10-year is rallying and the yield's falling, then the mark-to-market's going to look better. But if it's where it is today, somewhere around 440, 4.5, no, that means that the industry is going to have a bigger mark-to-market problem. And unfortunately, David, they are sitting on it. Only the better managed banks have kicked this stuff out because they did the math. The math says sell the bonds, and especially in the third quarter. That was a perfect time to sell some of this paper, take the loss, and reinvest the net proceeds at a higher coupon rate.
Mm-hmm.
You dig your way out of the hole. And I've argued the Fed should do this too. The Fed should take their mortgage paper, slice it up into collateralized mortgage obligations, the old CMO model, and sell them. They could keep the tails. They'll keep the high risk stuff. And maybe they hit a home run. If long-term rates fall and Trump reduces the deficit, then Jay Powell can hold his head up high again, and he won't have to worry about, $250 billion worth of losses so far. Those are real losses, by the way.
Is this a concern, though? Like you said, the financials have been doing well. The markets are, either ignoring this or discounting it. Paper losses, will they be translated to operating losses anytime soon?
They are a drag on earnings because you're getting paid 2% instead of 6%. Okay. So if you're Bank of America and you own $500 billion worth of securities, a big chunk of that is mortgage-backed securities, and they have a yield of 2%. It's in their disclosure. If you go to the page in the supplement for Bank of America and look at the yield on all of their different asset classes, it's right there. PNC has done very well with this. Truist. There's a whole group of large banks that are sitting with this stuff because they don't want to take the loss. But they're making a mistake because if you sit with this stuff long enough, it's going to kill your earnings. And I think that's why Warren Buffett got out of Bank of America. He can do the math.
So what's the risk for investors here? Looking at this chart, perhaps this next chart here.
If long-term yields, if the 10-year goes to 5 or higher, the pain from these securities is going to get really tough. Let me mention something. In the revisions that were proposed to Basel, they were going to give banks a couple of years to take losses like this and not have them hit their earnings immediately. In other words, they could parcel it out over a couple of years. The insurance sector, the regulators for U.S. insurance companies did this a year ago. They said to them, look, you want to sell this stuff, take a loss, it won't hit your capital for 2 years. So that was a way to help them to do the right thing. My fear is that the regulators still aren't focused on this, David. I don't hear any of them talking about it. They all think the Fed's going to make the problem go away. But a 10-year Treasury at 5% yield, alarm bells will be going off because that is really ugly.
What would the banks do once Treasuries hit 5%, the yield hits 5%?
They're going to come to Washington and look for salvation. Because let me put a number on that for you. A 10-year at 5% yield, you're talking about a negative capital position for the U.S. industry of about $3 trillion. A minus sign of $3 trillion. That's tough for them to operate with that kind of situation.
Well, wouldn't their profits in the loan books also increase if the yield goes up?
Yes, the loan books have been a source of lift. The average yield on loan books today is about a 6. So that's good. And that's happened recently, but they still own a lot of loans. They own a lot of old loans. So the average yield on that loan book is, it's still slowly climbing. The securities book, no, because what's happened is banks were sellers of mortgage securities in the past couple of years. They were getting rid of the higher coupon stuff to raise cash, and they kept the 1.5s and 2s. The Fed owns most of the 1.5s and 2s, Fannie, Freddie, Ginnie, out there now.
What are you doing then with the banks? Warren Buffett got out of Bank of America, you said. Are you getting out?
No, I'm mostly in preferreds. I got out of Common a couple of years ago because I just didn't like the dynamics.
What else is the best in trade for you? We talked about gold. We talked about yields and financials. Anything else that could do very well or not do well under this 3-3-3 philosophy?
I think if he makes progress on the budget deficit, that's going to be very good for bonds. You're probably going to see a rally because nobody's talked about that word in Washington for the past 4 years. He's going to have to do a lot of work on that. That's kind of the big picture. They're going to work on corporate taxes. They're going to work on keeping some of the Trump tax cuts that are going to be expiring. But I think, there are some fairly conservative members in the House who are now part of the majority. And these people want to see deficit cuts. They want to see the education department and the energy department and some other things go bye-bye. So I think, if anything, Bessent is going to be a moderating influence. And he's going to be, kind of in between Donald Trump on the one hand and conservative Republicans in the House who really have been waiting to get an opportunity to do a lot of things that they couldn't do. Remember how many times the leader in the House almost got shot over the past couple of years. It was very difficult for moderate Republicans.
Okay, so let's evaluate. We talked about some investment opportunities and risks. Let's evaluate risks for the average consumer. Starting with the financial sector. What do higher yields mean for, let's say, the community banks, the regional banks? Are they at risk of failure? Will people lose their deposits? That's what people are ultimately concerned about.
No, I think the deposit situation is under control. FDIC has done a lot of work to calm everybody down after Silicon Valley Bank because they had to ask the president for a systemic exception. They had to basically bail everybody out. Meanwhile, that small bank that just failed out in the heartland, they didn't bail everybody out. The big depositors have to wait. So I think there's still going to be a tendency to go to the larger banks for safety. You saw that after COVID. But I think generally the public should not worry about the deposit side. The FDIC is very good at this.
Should we worry about inflation coming back?
Yes. Yes, it's still here. When you see Bitcoin at 100, that's my favorite inflation index. That tells you just how much people are looking for alternatives because they don't trust the ability of the dollar and even, the nominal yield they get in their bank account or on their T-bills to protect them from a loss of purchasing power. That's really what that says.
Well, I thought the whole point of reducing the deficit and pumping out more oil is to slow inflation.
Well, look, energy prices falling will help inflation, but inflation is embedded in this system. 4 years of crazy spending, quantitative easing by the Fed, a whole raft of things that we've done really in reaction to COVID has enabled prices, for example, for homes to keep rising. The Fed would probably have to push mortgage rates up to about 10, 12% to get home prices to fall. The last time you saw that was Paul Volcker. Fed chairmen have been afraid to do that because they don't want the market to implode. They don't want deflation.
Do you think that with Bessent being appointed, the Fed is more reluctant to cut rates?
No, if anything, they're going to be encouraged because I think they'll view Bessent as a stable voice of moderation. Like I said, he's going to be in the middle. He's going to be, on the one hand, with a lot of conservatives in Washington who want to make big changes because they control both houses. And then you're going to have the Democrats and everybody else on the other side screaming at him. So Bessent is going to act as the adult in the room, I think. I think it was a good choice. I'm not crazy about the Soros connection, but I think we can probably live with that.
Okay. Well, any major changes from the Yellen days that we can expect?
Oh, yeah. No, Bessent is much more competent financially. Janet Yellen really had no brief as far as finance or the markets. She was totally lost. She was much more comfortable talking about global warming. So I think that Bessent is going to help the U.S. It's going to help Trump. It's definitely a positive, which is why the markets reacted the way they did.
Speaking of Trump, what is the broader Trump trade for you? We haven't talked about tariffs yet. What's the market impact of tariffs?
Well, it's going to be interesting. I think the tariffs with China are a given. Lighthizer going back to the U.S. trade rep and just the whole team they put in place there. It's going to be very, very much about enforcing the sanctions and continuing to get tough on China. I don't know how you change that because China is so explicitly mercantilist in their policies. They are a predator state when it comes to trade and finance. So I think the U.S., unfortunately, has no real choice. And then the U.S. is going to be beating up the rest of the world on sanctions against Russia over the Ukraine thing in the Middle East. It's going to be more of the same there. I can't see that changing in the near term. But, Trump is much less prone to war. You don't have Victoria Nuland and all of these neocons that were working for Biden in the Trump group. And even the pushback you've already seen on his choice for intelligence head, that tells you that there's going to be a lot of fights on the Hill because the defense community has a number of sponsors, both in the House and the Senate. And they're going to push back when Trump is trying to downsize the military, reduce the number of engagements around the world. It's going to be very much of a clash of values, I think, and not good for defense contractors, definitely, in terms of earnings. And then you're going to have Elon Musk looking for fraud and abuse. So we'll hear a lot about that. That's not going to be particularly good for stocks.
Elon and Vivek want to downsize the government. Any trades that could be directly implicated from this downsizing?
Well, there may be some things that are privatized. Student loans. You may see an end to federally guaranteed student loans and see them turned into a private market. I'm not sure that's going to work, but they would like to get rid of the Department of Education. That's really what the Department of Education does primarily, is take care of the student loan program. And then, I think for the banks, it's going to be a big positive, much less regulation. Same thing for the mortgage space. Some of the leaders in that market are going to be much better off in terms of just expenses dealing with regulators. The states are still there. You still have states like New York, which are a pain in the ass. But I think overall financials are going to get some lift just from getting away from the inquisition that we had under Joe Biden. I mean, the Biden people in housing and at Treasury were quite pathetic. The guy at the Consumer Financial Protection Bureau, Elizabeth Warren's little child, he was awful. He was fining people left and right. So I think you're going to see the Republicans try and get rid of that agency, by the way, and make some serious changes in the regulatory environment. Basel for the banks may go bye-bye entirely, David. Imagine that.
Bitcoin and gold. Let's talk about that. So like you said, Bitcoin almost at 100K. That's your inflation indicator for you. Gold has historically been seen as a good inflation indicator too, though, but it's been going down the last couple of days. What's going on there?
It had run up a bit, but it still has a very muted trading pattern because most people don't think about gold. Most people are looking at things that move more, the shiny object. And I think that's really the story with Bitcoin. Bitcoin, since we have ETFs that are onshore here in the United States, is going to trade more like a traditional speculative asset. Whether or not the connection between the ETF and the actual Bitcoin market, wherever that is, right, is accurate or not doesn't matter. It's taken on a life of its own. And I think, for better or for worse, it's going to be there. I don't expect to see them declare Bitcoin legal tender or anything like that. Because I don't think they could get that through the Congress. But certainly it's a more friendly environment. But you know what? Next time there's another scandal or another fraud prosecution involving cryptocurrencies, it'll go down. The big problem with crypto is that if you touch the actual crypto asset itself that's traded offshore, you almost immediately get into problems with FinCEN, know your customer, all of this stuff. And people don't want to be involved in that. If you're in the United States, you've got to be totally on the grid. You can't have one foot out.
Are you making a distinction between Bitcoin and cryptos or not so much?
Well, no, they're pretty much all the same. They have different components. But the point is that when people outside the United States can trade it, you have a problem, almost by definition, because if you can't validate who you're trading with, you may get a call 3 months from now from the guys at FinCEN. I just had to do my little declaration for my LLC. Everybody in this country has to file a form with FinCEN this year to tell who the beneficial owner of a corporation is. Everyone. And there are serious penalties for not filing. So, the government is focused on this from a bureaucratic perspective that really is beyond politics. And I think, people in the investment world have to be cognizant of this. And, I'm a member, affiliate with a broker-dealer. And I got to tell you, if you are even trading cryptocurrencies, it's a flag for the compliance department. They want to come and talk to you. So anybody who's licensed and works in finance, anybody who works with customers, has got to be really careful of crypto nowadays.
Yeah, that's probably maybe one of the reasons why it hasn't broken up above.
Well, no, but we have ETFs. Yeah. That's the key thing. The fact that you have onshore products that let people play with this stuff is good in a way because, for a domestic U.S. investor, they don't want to be involved directly trading the asset. That's only going to cause them heartache. And trust me, FinCEN's going to make the rounds because they have big fines. They like that. That's how they finance their organization.
Bitcoin or gold, which do you think has more upside in 2025?
Probably near term, probably Bitcoin. But I think gold is going to come on because the Asian countries aren't going to stop buying it. The Russians certainly aren't going to stop. And I think the Treasury ought to be exchanging for paper for gold. It's obvious. why wouldn't you sell fiat dollars and buy gold? To me, it's the obvious trade. So I think medium term gold is actually going to be quite interesting.
You're talking about the government or the central bank, the Federal Reserve? Well, central banks in Asia have been
Or
buying gold.
you may see the Fed pushed into putting part of its reserves in gold. And frankly, they would do a lot better with that than they've done with their securities portfolio.
It's interesting. The Eastern central banks have been buying gold. The Western ones, not so much. Why not?
It's just choice on the part of each country. Most of them like to have liquid tradable assets that have a yield. Gold is the only form of money that's not debt. So it doesn't have a natural yield. It just sits there.
Yeah.
But the accretion in gold is interesting because there's continued commercial and other demand, especially in China. The financial problems in China have made local gold volumes surge because people are afraid of what's going on in the property market. They want a place to hide. There aren't too many sectors of the Chinese economy other than housing where individuals were allowed to play. You know what I mean?
Yeah.
So gold, physical gold, is actually a nice hedge, especially the smaller denominations, smaller coins, smaller bars. They're very popular.
Is gold the best tool for the job, though, given its use case for central banks? Keep in mind, you're right, it doesn't generate a yield by itself. One could argue it has a negative yield if you factor in storage costs.
Oh, yeah, definitely. For monetary gold, you want a central bank like ours who's going to keep it for you for free.
Mm-hmm.
But no, I think it's symbolic. And frankly, I think gold is dramatically undervalued. If I were at the U.S. Treasury, I'd be buying gold until I got it up to $100,000. Because I think the rate of inflation in the U.S. since Roosevelt's arbitrary peg at 35 has been much, much higher than the price increase in gold.
At what price does it make sense to you that it's no longer undervalued? Does it matter?
I don't know. You'd have
based on
you'd have to really go back and regress the annual inflation rate each year. But the dollar's lost 99% of its value since the Great Depression. So the gold price hasn't gone up that much.
Finally, I'd like to close with some themes of your upcoming book. It's called Inflated Money, Debt, and the American Dream. Tell us about that. What's up with the American Dream, Christopher? Is the American Dream still alive?
It certainly is alive. It's changed a lot over the course of the book. I issued Inflated in 2010 with John Wiley, and we've updated it, added an awful lot to the end, another chapter on Ben Bernanke and Jerome Powell. And I would tell you that it's an interesting process to review American history, but what you really learn is that not much has changed. We provide a very, I think, concise overview of the country since inception, when we were using foreign money and barter, really all the way through the Civil War. And ever since then, Americans have been ingenious in inventing new currencies and new games as we've gone through time. People forget that before we created the Fed, we had 6 different kinds of money in this country in 1900 when Teddy Roosevelt was president. So we've gone through chaotic periods of free banking. And then since the Depression, the government has had a monopoly on money. That's what the fiat dollar represents. You have to use it. And after World War II, it became the world's currency of choice. But we pay for that. Americans pay for that via inflation. So I think it's an interesting story, but look, everyone wants to come here. One of the reasons Donald Trump can impose tariffs is because everyone wants to go to Disneyland. And what Trump is saying is, if you want to come here, you got to pay.
We talk a lot about the inflation of monetary assets, financial assets. What about the inflation of job opportunities? Do you think wages and opportunities and job prospects will also be inflated, meaning more opportunities, prosperity for all?
No, I don't. I think the individual is confronted with a great challenge as we go forward in this century, which is you need education. You need to really be aware of your surroundings, what's changing and what's not. And you have to be flexible. You have to be ready to remake yourself multiple times during the course of your life. So you want to start with skills. And you want to be as open and as, I think, discerning as you can about where to spend your time, because whole professions, David, we've watched it, have disappeared. You look what's going on in the auto sector globally now with volumes down. When they get rid of those jobs, they will replace those people with machines. And I think that's the big challenge for the future. The traditional labor business case is going to have to become more of a technology-based role for people. And I think it's going to be very challenging as we go forward.
Would you be short American auto companies right now, just based on what you just said?
I wouldn't be long. I own Toyota. I bought Toyota because I think they are a survivor in the global competition. I think they know more about electric cars than anybody and material science. And I think they are very close to being able to actually roll out a hydrogen-based solution for transportation. So, those I think are very exciting things. That's the kind of technological change that we need. Using lithium batteries to power cars is the most retrograde thing I can think of. I wrote a book about Henry Ford, and him and Edison wanted to build electric cars in 1902, but Edison looked at Ford and said, "No, use gasoline. It's a more compact source of energy." Still is. The gasoline engines today are so much more efficient than they were when I was a kid that they're actually reasonable to use. So I think we need other choices. If you look at the losses that Volkswagen and Ford and many other automakers have taken because the politicians told them to do EVs, or look at China. China has fields and fields full of electric cars that nobody wants.
Well, that's an interesting discussion. Let's end it here. So, the direction of the auto industry and the gasoline sector, energy sectors. We have seen, like you said, Volkswagen, Audi, Audi's owned by Volkswagen, but a lot of German companies, a lot of American companies, GM as well, rolling back on their EV-only promises by a certain date, right? Mercedes as well. So why are they doing this?
The technology's not there.
I mean, Jaguar's an exception, but that's a different story. But yeah, but
look,
most companies are rolling back. Yeah.
They can't charge enough for the car to justify the cost. Look at the F-150 Lightning, the all-electric Ford pickup truck. It's an awesome product, but they can't charge enough for it. So that's the problem. I think, we have to do something besides batteries. We need to have a power source in a vehicle that makes them reliable. I think right now Toyota's right, hybrids. You want to help people reduce gasoline consumption. You want to be, ecologically sensitive, get a hybrid. It's much more practical for your family.
Okay. Christopher, excellent thoughts. Thank you. Where can we follow your work? I mentioned your book's coming out next year, but right now.
Well, I published the Institutional Risk Analyst blog. I write a column for National Mortgage News if you care about housing. And I am available on X at RC Whalen. So come join the conversation.
Okay, good. Well, give us a teaser on your outlook for housing. We'll read more on your blog. Rates are coming down. I'm talking about mortgage rates are expected to come down some more. Boom for the housing sector or no?
No, right now we're writing 6 7/8 for 30-year fixed. That's up significantly since September. In September, we were down into the fives. That for VA refinancings, which are usually the lowest yield out there in the mortgage market, they were at 5.5. Today they're at 6.5. So I think that, we're going to see rates kind of stay where they are. Spreads have to tighten. The only thing that could change this is if the Fed starts buying long dated treasuries and God help us mortgage backs, but that may come.
Excellent. We'll put the links down below. So make sure to follow Christopher there. Appreciate your time as always, Christopher.
Thank you, David.
Speak again soon.